Have you ever thought about how a company saves up for a bill that isn't due for, say, 50 or even 100 years? And we're not talking about building a new factory here. We're talking about a massive, legally required cleanup. Well, today we're going to crack open the rule book for these giant corporate piggy banks, a set of rules called IFRIC 5 that deals with billion-dollar environmental cleanups.
So let's just start with the main problem, right? Picture this. You're in charge of a nuclear power plant or a giant mining operation. You know for a fact that decades from now, you're on the hook to safely shut that whole thing down. And that process, it can cost billions of dollars. So how on earth do you show that enormous future expense on your books today? That's the puzzle we're going to unpack.
And here's how we'll do it. First, we'll look at the sheer scale of the problem. Then, we'll introduce the solution they use, something called a decommissioning fund. After that, we'll dive into the accounting puzzle it creates, see exactly how the IFRIC 5 rulebook solves it, and wrap up with why all this is so important for investors and, really, for all of us. Okay, first things first. Let's really set the stage here, because we are talking about some huge, long-term costs that are absolutely not optional. Just think about it for a second. When a company builds a nuclear reactor or digs a massive mine, the government doesn't just let them pack up and leave when the party's over. Nope. They are legally bound to pay for the enormous job of making that site safe again and cleaning up the environment. This isn't some maybe what-if cost. It's a guaranteed bill coming due in the future. So how do they prepare for a bill that big? Well, they create a very special, dedicated savings plan. Let's take a look at the Decommissioning Fund. The official name for it is a decommissioning fund, and its whole purpose, as you can see, is to wall off a chunk of assets specifically for those future cleanup jobs. This money is basically put in a financial lockbox so it can't be touched for the company's day-to-day business.
Now this is where it gets really interesting. These funds have some very specific features. First, the money isn't just sitting in the company's checking account. It's managed by independent outsiders, trustees, and it's invested so it can grow over all those years. But, and this is the most important part, even though the company is putting money into this fund, it still holds the ultimate legal responsibility for the cleanup. So the fund is there to help pay the bill, but if the investments do poorly and the fund comes up short, the company is still on the hook for every last penny. And finally, if the fund does really well, the company can't just take the extra cash and run. Access is usually restricted.
And this unique setup, where you've got money saved but you still owe the full debt, creates a really fascinating puzzle for accountants.
So, here's part one of the puzzle. You've got this massive liability for the future cleanup sitting on your books. But you've also got this growing pot of money over in the fund. So how do you show your piece of that fund on your financial statements? Can you just, subtract it from the liability to make the debt look smaller?
And then it gets even more complicated. What happens if other companies are paying into the same fund and one of them goes belly up? Well, a lot of the time, the companies that are left have to chip in extra to cover the gap. So how do you account for that? It's a potential cost, not a definite one yet. It's a huge risk just sitting there. And this is exactly where our hero, IFRIC 5, steps in. Now, IFRIC stands for the International Financial Reporting Interpretations Committee. Yeah, it's a mouthful, but their job is basically to tackle these super tricky accounting questions and create a clear rule book so everyone is on the same page. As you can see, this rule isn't new. It's been around since 2004, and it's a core part of the International Financial Reporting Standards, or IFRS. Those are the global accounting rules used in more than 140 countries, and it's been tweaked a few times over the years to keep it up to date. All right, this right here, this is the absolute heart of IFRIC 5. A company can't just smash these two things together. They have to account for them separately. So on one side of the books, they have to show the full, scary, massive liability for the cleanup. And on the other side, completely separately, they get to show their share of the fund, but they call it a right to reimbursement. It's a brilliant way to show both the promise and the piggy bank. But there's a catch for that reimbursement. The company can only claim an amount that is the lower of two things, the size of the cleanup bill or the actual market value of their share of the fund. This is super important because it stops a company from booking a giant profit if the fund's investments go wild and grow to be worth way more than the actual cleanup cost. You can only recognize an asset up to the size of the bill you actually have to pay. So, what about that other tricky problem? The one about having to maybe chip in more money. Well, IFRIC 5 says that's what we call the contingent liability. Basically, you don't put it on your main balance sheet as a sure thing, unless it becomes probable that you'll actually have to pay. But, and this is a big but, you still have to tell people that this risk exists.
Which brings us to our last and maybe most important point. Why do all these nitty-gritty rules even matter? Well, it all comes down to one simple, critical idea: transparency.
See, IFRIC 5 forces companies to spell things out in the notes of their financial reports. They have to explain what their deal is with the fund, tell everyone about any restrictions on getting to that money, and crucially, they have to disclose that potential obligation to pay more, even if it's just a remote possibility. It's all about giving investors the complete, unvarnished story.
And that quote on the screen really just sums it all up, doesn't it? The whole point of IFRIC 5 is to make sure a company's huge, long-term environmental duties can't be hidden or minimized. By keeping the debt and the savings account separate, everyone, investors, regulators, the public, can see the true size of the company's commitment. It's all about accountability.
So we'll leave you with a final thought to chew on. IFRIC 5 does a great job of handling today's cleanup costs. But as we all put more and more emphasis on corporate responsibility and sustainability, how are these accounting rulebooks going to have to change and evolve to make sure we're always getting a clear, honest, and transparent picture of the promises companies are making about our shared future?